Welcome, everybody, to our inaugural episode of Built to Grow. So, yeah, super excited about this because we've had our other episode with Brady CFO called Built to Scale. And now we're launching our new episode called Built to Grow, focused in the food and ag market. So, we have our guest today, Brett Bronstein. Welcome, Brett.
Thanks for having me. I'm excited to be the first of hopefully many for you.
We are talking about the very, very sexy topic of, AR risk management, right? So,
Hope you had your coffee, right?
yeah, maybe we should fill up here for everybody. But yeah, for our audience, Brett is a vice president, One Source Risk Management and Funding. Brett and I caught each other at a Fresh Produce Association event here in Texas. And, Brett has worked with fresh produce and food companies in the past. And one of the things that, a lot of companies don't quite understand is their AR, and it is an asset on your balance sheet, right? And it's an asset to be protected just as much as you would get insurance for other things to make sure that, you can cover against risk for other assets and any events related to that. AR is much the same. And so we're going to be diving into that. But, I think outside of just AR, insurance or anything related to the risk of AR and insuring that, we want to dive into AR management as a whole. That AR again is an asset for food and ag companies. Reality is we all wish that we could say that, hey, you're going to pay me today for the work I'm doing or the products I'm delivering to you. That's just not the likely, reality of the industry. That, if you sell your products to a major retailer direct or to wholesalers, whatever the case may be, generally you're going to have an invoice with net terms and you're going to have some AR management in place, as well as, all of this has to be, taken into account with, who are you selling to, what's happening in the industry. Not having a purview of these things, I find, can put companies at risk. So super excited to dive in with you, Brett.
Absolutely. We're really looking forward to the conversation, Mason.
Yeah. So let's kind of start off that obviously this is a food and ag related podcast geared towards the food and ag industry. Um, you know, the past several years for the food and ag industry, it's been wild. I find that, at least from my vantage point, that COVID kind of sifted some things in regards to, okay, if you were selling food products or commodity products direct to retailers, you were probably going to be okay. If you're selling to wholesalers, oh man, you were bust. Inflation of various inputs in regards to food and ag companies became a real big issue, and I think, in my vantage point, I think that there's a lot of companies still suffering from some of that. Like balance sheets are, suffering. And I think this is a bit anecdotal, and that's why I'm bringing this up. Is that a lot of companies had to deal with rising cost, and they probably couldn't pass along those costs to their customers as well as they wanted, and so they're dealing with shrinking margins, suffering balance sheets. But um, from your vantage point of, from One Source Risk Management of viewing companies of what's going on, what can you tell us about the state of the food and ag industry? What all are you seeing out there?
Yeah, a lot of information to discuss there. I'll start just with the obvious. We talk about the cost of the product. I mean, that has gone up significantly over the past couple of years. There's been several things that have attributed to that. Number one, you look at inflation. I mean, that's continued to be an issue. It's caused, or I should say, it's been caused by a lot of things that have been out of our control. You look at a lot of the natural events and disasters, droughts, floods, that has a major impact on crop growth and crop development. You look at tariffs. Tariffs have impacted every subsector of the food industry, especially food manufacturers, especially farmers. And then you look at the risk side. That's really what we focus on, is the credit risk of these companies that are trying to get credit terms from their suppliers. And that has significantly increased over really the last 12 to 18 months. And it's really especially more risky for the companies that have run out of capital. A lot of these companies are heavily reliable on their funding. Interest rates, they've been a significant concern. It's making borrowing a lot more expensive for companies, especially with substantial debt. And a lot of these companies have capped out their borrowing, and they've had to deal with the rising costs of the product, and as well as trying to struggle with growing their business. So you look at what we're seeing from a credit side, a lot of companies are turning to some type of protection on their accounts receivable, such as trade credit insurance. We're seeing a lot more bankruptcies in this sector. Insurance companies are becoming a lot stricter, a lot more conservative with the coverage that they're extending. And you look at every single subsector in the food industry, they're all affected. We've got these uncertain economic environment. It's making consumers more price cautious, I should say. Apologize about that. And that's really affecting everyone in the food service companies. They're struggling with sales. You're seeing it in restaurants with they're struggling to get customers. People just aren't going out to eat nearly as much as they did. You look at stricter regulations around food safety and labeling. This is beneficial for you and I, the consumers, but it's increasing the cost and the compliance for a lot of these companies out there. So, all in all, it's really made a perfect storm for a pretty poor risk environment for this industry.
We have generally felt, and we have seen with several of our clients, I mean, some are thriving, but there is a lot on a thin line that, I mean, if just the next domino hits, they will not be prepared for it. Like they've had enough dominoes hit that if the next one hits, they have nothing left in the tank in order to manage that. And I love that you brought up, because we've especially seen it since this is a part of what we focus on in Brady CFO for some of our clients is the access to financing. With higher interest rates and the fact that generally it feels like there's a lot of companies that probably balance sheets are hurt, that they had to go through some past years with some difficult margins. It has felt like a lot of banks and their lending, capacities, even private lenders for that matter, at least we've seen, their willingness to lend has also been very, very conservative. And so, all that said, the ability to weather storms and have access to outside capital, it's hard. It's hard out there. And so, yeah, the question being, I think it really comes down to is that for some of these companies, if you're selling, a set amount to a customer and they end up not paying those invoices, can you really handle that, right? Like, I mean, can your P&L and balance sheet truly handle that? Or are you going to be put in a dire situation? And so I love that you kind of set that up there. And I guess I just wanted to highlight, that borrowing function that we definitely see and I would love to see that in 2026, some of that eases up, but it's certainly, we have even a future guest coming that, him and I kind of prepped for a chat, and we said, yeah, it feels like with a lot of food and ag bankers that you go for, new bank financing and you get a lot of strong maybes out there. You don't get too many people saying, yes, we will lend to you. You get a lot of strong maybes out there. And so that fact that with that in place, and can you really take a big hit on your AR if one of your customers went bankrupt, something happened, or you just didn't get paid for whatever reason, are you prepared to take that hit appropriately? I'm interested, you've kind of given us some insight into what's been happening. Do you have any crystal ball thoughts, and realize we're not holding your feet to the fire, but just what are you thinking about 2026 and beyond? What is one source thinking as, they're evaluating what's happening in the marketplace?
Sure, sure. There definitely are some opportunities for this year. I don't want to make it seem like it's all gloom and doom for this industry, but some of the opportunities I would say, number one, you look at production. Production is becoming faster. It's becoming safer, and that's really due to increased automation, improved tracking systems for these types of businesses. We're seeing a lot more sustainability efforts, reducing waste and energy costs, which this can potentially lead to a lot of long-term savings. You've got the One Big Beautiful Bill Act. It's getting a lot of news, and it's really expected to boost the GDP growth in 2026. So yeah, there certainly are some opportunities, and really for the larger, more established businesses, those types of companies are always going to, they adjust their prices, they reduce their costs, and they even see improved financial health. And it's really the smaller, the startups. Those are the ones, and as you mentioned, from a bank financing perspective, that's putting a lot of pressure on these companies, especially those that are highly concentrated, maybe on one single customer. So those are some of the opportunities. I think that the climate and weather events, floods, droughts, storms, that's going to continue to be an issue. disrupting crops, manufacturing facilities, a lot of companies with a significant debt. We've touched on that a few times. They may struggle due to the higher interest rates for this year. We've got tariffs. Tariffs is an ongoing concern pretty much for any major industry. Shifting trade rules, those are adding cost unpredictability. We're seeing that a lot in some subsectors like coffee, produce, packaging materials is struggling with that. But really, all in all these things are going to affect these companies' credit ratings. And when they look at getting product from their suppliers and from their vendors, it could be somewhat challenging for them to get product for them to then sell and make a profit themselves.
Yeah, I think it's kind of interesting. I whatever side of the political aisle you're on, I'm not, saying anybody should have a particular side or trying to, maximize a particular side in this. But, um, from an economic standpoint, I generally feel like I get the sentiment like it's not like there's super significant progress economically that, but at the same time, is it the worst thing in the world? I think consumer sentiment would probably give it a neutral factor to some degree. That at least with tariffs, um, you know, now it feels like they're in a position where we generally know what we're dealing with because it felt like for a couple quarters there, it's like, well, like, are we going to expect 50% on something that's just coming down the pipeline because Trump's pissed off, and all, he doesn't like him, and like, could it go from 10 to 50 to 50% here pretty soon? All of that has kind of settled. So it feels like people that were kind of on the sideline wondering, whoa, like, what do I do here? Now they know how to plan. Interest rates have come down a bit. We'll see if our Federal Reserve chair ends up in prison or not, according to the news today, right? And where interest rates are going to go. But interest rates have come down. It feels like there's some ability to plan, and I think even for myself as a business owner, it's like, you know, you still don't know what's to come, but when you feel like you can plan and it doesn't feel like there's so much disruption that was felt in 2025, like, okay, you have a path forward. And I think considering all that, yeah, I think food and ag companies that, hey, maybe people's budgets, maybe they're not quite exactly where they want to be, that they have all types of extra money to spend. So, from a product standpoint, probably continue to deal with retailers, probably maximizing some business with retailers, making sure that they're still a little bit cautious about a lot of food service out there that, hey, can people go spend all the money on restaurants? Probably not a bad plan. But yeah, I think it'll be interesting too, though, because 2025 with the tariffs and everything felt so disruptive. And yeah, I mean, who knew that we were going to go get Maduro, a couple of weeks ago, right? So like, who knows what 2026 has to hold? But I think I think generally for companies, still, like, I guess I would like to say as a summary whole, like, there's opportunities. Um, Cautiously optimistic is still the right way forward. It's not like, hey, probably go all in on things, but be cautiously optimistic. Know that, hey, something could be disruptive, but know that, you may have been through some disruption. So seek to rebuild that balance sheet, seek to rebuild some things. And, one of these key pieces that we're now going to dive into is the AR on your balance sheet, right? Like who you're selling to. You want to maximize sales. You don't want to say no to a sale opportunity. Like you got to be able to achieve that growth. But AR management is a really critical function. And I think for us, we've seen, a lot of smaller mid-market companies, they're just so ecstatic once they get that first sale. Like, hey, I got the invoice. I got the purchase orders, I should say. I got the purchase orders and I can send out that invoice. I can ship to them. I'm ecstatic. I'm super excited. And then it finally hits, oh, wait, wow, I have to wait 60 days or my terms are 90 days, or, et cetera, et cetera. And I don't even know, like, is this person, they said that they would buy all this from me and they don't seem to be paying me. What am I going to do now? I'd like to dive in with you because obviously AR, insurance and risk management, that's one aspect to it. But like, let's dive into how can companies manage AR as a whole? Like, what are some recommendations you have from your vantage point as to, even just outside the insurance product, like how can companies make sure that you have the best chance of getting paid as best as possible?
So it's a tough question, and I would even take your statement and maybe even rewind a bit further. I think the excitement for these companies starts when they first get that credit application from a brand new customer, and they've got the deal, and they take it to their credit department or their finance department, and they say, "Here you go. This is going to be our saving grace. It's going to be a great customer. They're going to buy. They're going to buy a lot from us." And then, as we know, that always doesn't come to fruition. But besides, I won't talk much about the insurance side, but other practices these companies have to take. I mean, most businesses out there have some type of standard credit process. So it's typically going to involve a standard application where they're getting as much information from these companies as possible. You start with the references, the trade and bank references. Now, people have mixed emotions about those. I just to give you an example, my wife and I, we bought a car last year, okay, and we financed it. We're sitting with the finance department filling out the paperwork, and there was a question on the paperwork. It asked for references. I put my best friend from college and I put my mother-in-law because I knew they were going to say good things about me. It's no different with these companies. When I give a credit application to a prospect, I know they're going to give me the best customers without even me reaching out to those companies for the information. I know they're going to say good things. But it is a practice that probably needs to be done. Past that, there are mercantile agency reports out there, Dun& Bradstreet being the largest and most well-known. So these are going to give companies some additional insight into what other vendors and other suppliers are saying about them. What has the high credit been? Have there been any past dues? Have there been any liens, any judgments, any bankruptcies? So these are all good steps for companies to take. There are some specialized credit agencies within the food sector. One that comes to mind is Blue Book, which is very big for the produce industry. So gathering as much information from these companies as possible. But at the end of the day, it's all, especially where we live here in Texas, it's mainly a handshake in an agreement to pay. And past that, once the supplier delivers the product or the service, unfortunately, it's out of their hands. And unfortunately, at that point, they just have to sit back, cross their fingers. If they're religious, maybe say some prayers that they get paid, because past that, they can't really do too much.
You have some really great examples there. A couple additional points that I think are just worth mentioning to our audiences from past experience, especially particularly in fresh produce, because I know that we're talking to a variety of food and ag companies, but especially fresh produce. There's what's called PACA, the Perishable Agricultural Commodities
Yeah,
Act.
didn't
Under,
talk about. Yep, good
yeah,
point.
understand that well, because one such, part of that is that even, if your customer asks for changes to net terms beyond net 30, my understanding is, and don't quote me on this, but my understanding is you officially void your PACA, rights at that point, which PACA is meant to protect the growers and the suppliers that if that, if that customer defaults, you ultimately become first priority in a bankruptcy, even above, other creditors that you as a supplier, grower, whatever that might look like, ultimately prioritize. And I'm summarizing this in a high level way, but the idea being that the moment that you change your net terms, to be favorable to that client, you could be voiding some rights that you have to help protect yourself. So educate yourself on PACA if you're in fresh produce. I think the other thing too is just the good old fashioned limit, like literally to just have a credit limit that, hey, with a new client account, especially if it's not a major public retailer like Walmart or something of that sort, if it's, you're selling to a broker over there that just started up their shop 2 years ago, it's certainly okay to say, hey, we're going to cap you at the total amount of outstanding invoices at any point in time is $100,000 as an example. If you want additional credit, you got to pay this down. And, and I think a limit is perfectly fine. That is a starting point, and that as the relationship grows and they perform against that limit fine, then, hey, you can extend more limit to them, and you could potentially even get rid of the limit over time and say, hey, they've proven themselves to be a quality customer and how they pay, and we're good to go.
Yeah, just to chime in there, Mason, and one thing I want to add to that, I always use the analogy, just because someone's qualified for a credit card doesn't necessarily mean they're pre-qualified for a house. And the challenge that a lot of these companies get into is they see these dollar signs, especially the ones that are real revenue focused and sales focused. They see these opportunities and they say, well, they've paid me, $5,000, $10,000 on the last invoice. Sure, I'll give them $100,000 because they just called me out of the blue randomly and they're asking for 5 or 6 times the limit that I was giving them priorly. So yeah, I mean you do have to be careful with those credit limits. A lot of companies we find don't necessarily adhere to those, but in to your point, yes, that's absolutely crucial.
Yeah, you brought up such a good example because I remember one instance where when I was operating as a full-time CFO for a company and we were doing a credit evaluation on a new customer, and we had a formal process where we'd go look at Blue Book and we'd establish a credit limit, et cetera. And we always wanted the sales team member that was, active in that account, that maybe it was they established the account. They were the ones that opened up the relationship, got the new relationship. We wanted to make sure that they were bought in, that it wasn't just, hey, like credit was just gonna say to them like, sales, you can only do this. Um, so we wanted to make sure that there was a mutual agreement that, hey, between sales and accounting, like we're in line for what's the plan with this customer overall. And I remember one time I went and talked with one of the sales team members and he said, well, all I know is that the owner has one of the biggest houses I've ever seen. So I think that they're doing pretty well. And I'm like, that is the worst answer I could hear, because just
Yeah,
because I know plenty of people that have beautiful houses and they're up to their eyeballs in debt.
dead.
And
Yep.
that means nothing. That means absolutely nothing. But that was just the way that they thought about it. It's like, oh, if you obviously have that money, it's like, that means nothing. So, um, you know, eh, it's important to kind of have some of these standard policies in place that, hey, go look at Blue Book, go look at Duns and Bradstreet. Worse is worse. And I know that I would say, especially with maybe a very new customer, that especially in the ag industry, there's a lot of brokers out there. There's a purpose that they play. I'm not going against brokers, but at the end of the day, if they're new and they're not established, you can also ask for a set of financial statements too. You can also just literally say, hey, can you kind of show me a little bit of where you're at? Because I just want to make sure you're not up to your eyeballs in debt and that, there's risk of me getting paid back here. So, all kinds of things here. And I love being able to expand this with you, Brett, because I think, it's important, I feel like, to actually have a management plan in place. And a part of this too is a final item. I've seen so many companies, make somebody accountable for AR. Like literally, they can have other duties in the business, but make one person that their responsibility is to go collect, and put a metric in place and literally say, hey, reward them for it. That if they keep the average AR days of all outstanding invoices, or, something, a metric of some sort, where they keep them within a reasonable range. And that's going to involve them calling up the customers and saying, hey, payment status, what's going on? You say you didn't get the invoice, let me resend that to you. Make it their responsibility and reward them for it. And honestly, I found that ends up solving a lot of problems, because, if you let things kind of sit out there for too long, I, there's a phrase to that I'm forgetting right now, Brett, but from experience, if you let things sit out there for too long, that's when the real problems occur. When you kind of let that customer that 3 months go by and they have all this aging, you really haven't touched that. That's when it becomes a oh crap moment.
A lot can happen in those 30 days. Keep in mind, in the meantime, they're trying to run a business as well. They're trying to get paid from their customers. And what happens if they don't get paid from their customers? Well, they can't pay you as the supplier and vendor. And you're seeing a lot of these, what we call these gaps between the credit side, or the accounting, credit, finance. Their goal is to protect the bottom line. They're looking at risk versus reward. Well, why do we want this business? Because it could hurt us this way, this way, this way. And then you've got the salespeople are over on the other side, and they're uber aggressive. They're looking at the top line growth. They're wanting to make money for themselves. They're wanting to grow the business. So you've got this huge gap in the middle. Okay, well, how do we stay conservative? And then also, how do we grow the business as well? And for some companies, they've never really found a magic answer to do that.
Yep, I agree. And kind of a final nugget there. as you were saying, it just made me think, which I think is a relevant thing, right? I mean, you talked about incentives, right? Incentives of different parties as to what each party's trying to do, and accounting, finance is trying to help protect the bottom line, manage risk. And then, sales might be incentivized on a commission basis for new revenue. And what might even be helpful is an incentive based upon net new revenue, meaning that if you have to write off that AR, that comes out of their incentive, right? That it's not just about new revenue, it's about good quality revenue too, right? But all these, you can, there's so many things that you can do to help manage AR. I would say to anybody listening, if you have nothing in place today, just putting in a credit check system for every new client, doing a little bit of, evaluation on the history of this client, how long have they been in business, trying to see what resources are available to you, like you said, like Duns and Bradstreet, maybe Blue Book services, whatever might be available to you to try to get some insight and to have a formal decision-making process in regards to what limit you're going to start them with. And then that can grow over time. That's probably the simplest thing of just starting, and then you can evolve from there ultimately and, move on. But, you know, there is a place, Brett, 100% that, especially I have all kinds of theories about where it potentially makes the most sense, but I know you're going to be able to tell the audience this concept of insuring receivables, right? That you're going to market, you're trying to establish new programs, you're trying to build your business. Sometimes just the best, most sound thing is just go ahead and insure those receivables and make sure that you're protected. So, kind of for our audience, explain that concept for us. Like, what is insuring receivables? How does it work?
Yeah, the one argument or the one objection I love getting from companies I talk with is we've never had a loss before, or we know our customers so well. We only deal with the good customers. And then we've got, I love hearing that because our product is really going to change their mind around that. So when you think about any insurance that we carry, whether it's life insurance, auto, home, general liability, any insurance you put in place for not the expected risk, but you put in place for the unexpected. I consider myself pretty healthy. My family and I, we exercise, we eat well. But guess what? I have life insurance and a very, very good policy. I'm a safe driver, but I can't control the factors around me. So I have a very good auto policy in case of the unexpected. And credit insurance is no different. It should not be dependent on what has happened in the past. It's really focused on, well, what would happen? What kind of impact would it have on your company's bottom line if one of your largest customers didn't pay you? Are you financially set up to take that loss and continue operating? And unfortunately, a lot of businesses out there are not set up that way. Especially those in the food industry who operate on really thin margins. If you have a $50,000 loss from a customer, you're going to have to generate maybe 10 times that amount in new business just to break even. And that's obviously affecting your profitability. That's affecting your ability to operate your company, pay your employees, bonuses, buy product. Everything is all centered around your accounts receivable. Of all the assets that companies carry, my opinion is the AR, the accounts receivable, is their riskiest asset. And in most cases, it's one of their largest assets. It could make up anywhere from 30, maybe 50% of their total assets. So they insure all these other assets, their building, their land, their equipment, but yet this really risky asset that they really have no control over once that product is delivered or once that service is produced. But yet, for some reason, companies do not insure that. And no fault to them. It is somewhat unknown in the United States. It has less than a 10% market penetration. It's much more well known overseas in continents like Europe. About 80% of companies out there use this, but unfortunately in the U.S. it's never really picked up much steam. It's starting to, and it is the fastest growing property and casualty product out there. But what it's designed to do is it's designed to pay the company in the event that their customers do not pay. So if that customer experiences any type of cash flow issues where they're unable to pay their suppliers, or worse yet, let's say they are forced into bankruptcy, any type of formal or informal insolvency, and all their debt is erased in court under Chapter 11 agreements, the vendors and suppliers, they're the ones that are going to have to suffer. So if I'm a business and I'm selling a product or a widget or a service, and I can pay a very, very small fraction of a percent to guarantee that I'm going to be paid, that's something that I'm going to highly consider and more than likely move forward with, because what it's going to do, it's going to give me that peace of mind. It's going to provide me with that guarantee. And the question I always ask clients and prospects is, which of your customers are keeping you up at night? Or for that matter, what does keep you up at night? Is it your receivables? Is it the fact that you've got this highly concentrated account and they've got, 40% of your receivables all in one bucket? How well do they actually know their customers? We talked about Dun& and Bradstreet. We talked about Blue Book. Mason, you brought up the point about asking for financials. Unfortunately, most businesses don't like sharing their financials. So what you're seeing is that these suppliers really don't have much visibility into who their customers actually are. Sure, they've gotten a couple references that, as we talked earlier, are all going to say good things. Maybe their Dun& and Bradstreet or Blue Book report looks solid, but past that, they really have no clue what the financial condition is of these companies. So, they really need to consider this insurance for their receivables, because it's going to provide them with that guarantee, and it's going to allow them to continue trading more aggressively out there, knowing they've got some protection in place. And then the last thing I'll mention real fast is from a financing perspective. If I'm a company and I'm highly leveraged and I use my receivables as collateral with my bank, most banks, most lenders out there will give better borrowing terms if that company has insurance in place. So I'm talking about a higher advance rate, talking about lower interest rate, more eligible receivables. So if I'm looking to grow my company and open up a new warehouse and I need more product to purchase to sell on my own, I'm going to need access to that funding. And a credit insurance is a simple way for me to approach my bank and get more access to my capital.
I want to hone in on a couple points there that, for our audience, we've regularly seen that, especially if a bank is offering you a line of credit, but they're offering under a product called a borrowing base, that usually they're going to do calculations to see ultimately what can they collateralize. So they're going to take your AR, your inventory, your cash on hand, and subtract some of your payables and say, okay, this is your actual net collateral here. This is what we will lend to you against. But when they do that calculation, AR, for example, it's pretty standard that outside of using, trade credit insurance, the factor, regardless of your history as a supplier, your history as a company, you could be a 30-year-old company, never have a write-off. They will factor your AR roughly at 70%. Like, give or take, they'll just say, okay, you could have $10 million of AR, but we're going to apply a 70% discount rate to that, and we're only going to count $7 million as eligible collateral, and then subtract 100% of your AP from that 7 million then, right? And what Brett is saying is that, the idea that if your AR is insured, they'll begin to move that discount rate up. There's a potential, I should say, that that bank could consider moving that rate up and make that, more eligible, because they're just trying to account for any potential losses. Like, they're just using historical kind of, statistics that, hey, we're just going to wipe off 30% of the value of this AR off the balance sheet because it could be no good. And therefore, this is the real collateral number. And but if it's insured, then, represents more legitimate and secure collateral. And, the banks like that. And I think, just as you were talking, I, again, I think sometimes we can be so quick to lose historical significance. And it's crazy to think, COVID started roughly about 6 years ago. I mean, 2020, and it's weird to think that it's 6 years old at this
I
point.
was just going to say, no, it hasn't been 6 years, but you're
Yeah,
right. Yeah.
yeah. I mean, we're recording this on January 16, 2026. About February 2020 is when COVID broke out in the United States and things began to shut down. Um, if you were a supplier, if you were a food company of any sort and you were a supplier to food service, your business came to a halt at that point. Like if the majority concentration of your business was to food service, because restaurants stopped functioning for a good month there, and then they had to figure out how to do to go orders. And if the majority of your business was in retail, you were solid. I mean, everybody was having to go buy their stuff in the grocery store, but generally restaurants, got hurt in a bad way. And so if the concentration of your business was in food service, um, and some of your customers could have been local food service operators of some sort. Yeah, you were taking on a lot of risk. And just because you never had that happen before, COVID showed us anything can happen, right? So let's please not forget, we have history that tells us this is true. It can happen. I think, tell me too, because I feel like we may have missed something here, Brett, of, you know, like there's financing terms that make reasoning for this. Um, there's just general good business practice that can make good reasoning for this, but especially for those clients that are going into new markets. I feel like trade credit insurance is relevant for going into new markets that, especially for a domestic supplier, maybe going to, overseas and wanting to penetrate, export markets. And, they're not there, in that export country, with boots on the ground 24/7. Where does trade credit insurance apply to that?
I mean, I think if someone asked me what is the biggest benefit credit insurance provides, I would say it's the ability to expand sales and grow the business more aggressively. Obviously, it is an insurance product, but the ability to go out there knowing that you've got protection in place. So if I'm a supplier and I'm getting into a new market, I'm gonna go in very conservatively. Okay, I'm going to make sure that I'm protected and maybe start out very small. So I find a new prospect. I find Mason's company who wants to buy some product from me, and maybe he's working with one of my suppliers, but I don't have any history with working with Mason. So I'm going to give him a credit limit, but maybe it's not the credit limit he's asking for, or maybe it's not the same as he's getting from my suppliers. So what does that force Mason to do? Well, that forces him to buy a little from me and buy the rest from someone else. Okay. Enter credit insurance. Now I have a fully executable insurance policy that says if Mason does not pay me, I file a claim and the insurance company is going to pay me. So what does that do internally? Well, that gives me the peace of mind. And now I'm not going to have as nearly as strict credit limits as I would before I had the insurance in place. So question I always ask my clients is, imagine credit risk was not a concern. Imagine every single one of your customers were backed by Walmart or Amazon or Target. How much more business could you generate? Which customers are you limiting that you could potentially sell more to, knowing that you're going to be paid? So whether it's domestically or, to your point, Mason, internationally, yeah, I mean the credit insurance is a fantastic tool to help companies get that growth that they've been wanting to. And then we talked earlier about that gap between the credit functions and the sales functions. Well, again, this gives them the best of both worlds. It's going to please my credit and finance team because they're going to be able to get some protection in place. And if we take on a hit, their jobs are not on the line. They're not going to be in trouble. And then it's going to allow my sales team to get out there and push for more sales, push more revenue, and make me as a business owner more money.
From a business strategic standpoint, in my experience too, if you're going into a new market, I've just experienced that very rarely, because let me kind of relate this back. I think the question or the alternative, Brett, of any contradiction to buying trade credit insurance is, hey, yeah, it costs money. I don't know that I want to spend that money. It's always an acceptance of risk that, am I willing to spend that money on the insurance? That is this that bad? And say you're selling 100 grand into a new market, or say you're trying to go in and sell $1 million into a new market, and the policy costs a certain amount. Yeah, could it eat into some of your margins? Yes, but that has to be weighed against the risk that, okay, but what if half of that $1 million wasn't paid back? What's the erosion there, right? But I think too, just a consideration for anybody from a general business strategic standpoint, whenever you're entering a new market, I have found that the first 12 months, or the first season, or just your first, period in that market, you're not going to make money. Your purpose is to learn and to establish your brand presence in that market and to determine, do you want to continue to penetrate this market? Like your whole first thing is just let's get in there and let's figure it out and learn. And throughout that learning, knowing that there's going to be hiccups, and the last hiccup you want to have is that somebody literally doesn't pay their invoice. And so, it's a really good consideration to have your products there, Brett. That and I'm literally telling this from experience that from a general strategic perspective, know that first year probably not your money making year. So protect yourself because it's not being your money making year, knowing that your entire strategy is to just penetrate and learn. And then you figure out how do we make better margins going forward. But especially in that new market, cover yourself, right? I just make sure that you pad yourself, you cover yourself, knowing that it's going to be a learning year. It's never going to come out as hot as you think. And it's okay. Take the risk, go into the new market, just understand the right expectations in it, right? So I think, Brett, we've gotten a ton of good value here. Um, a final point that I really want to, be able to have our audience take away, right? You know, we don't want to just go sell trade credit insurance. Like we want to talk about risk management as a whole. But yet, trade credit insurance is a very applicable tool that many food and ag businesses should be considering as a part of their toolkit. One final thing, though, if a client is starting, what signs should they begin to look out for ahead of time, that if they're properly, ideally they're properly watching things, but what signs should they begin to look out for that, hey, you may have some real risk here with your client beyond the initial credit check that they've been selling into that customer for some time? And man, what are the things that they should be looking for that, well, you could be at real risk of getting paid here?
Companies hate to admit the obvious that they're having cash flow or financial difficulties, so they'll give any excuse under the umbrella. The first thing you want to look out for is the length that the receivable has been out there. Is a customer current? Are they past due? Now, once they fall past due, that's when the company needs to start reaching out to the customer for some type of explanation and to try to get paid. When these customers start using these excuses of, oh, the invoice was lost in the mail. Hey, I'm waiting to get paid by my customer. I should have your money by next week. Hey, we've got a good relationship. Can you give me another 30 days? These types of excuses, don't worry about it, Mason. I know, I'm good for it. I've always been good for it. Those are red flags. And what's interesting is with trade credit insurance, the majority of the claims actually come from the longer tenured customers, not the new customers. Because if you have a new account, you're going to watch them like a hawk. You're not going to let them get past one day past due before you start calling them. It's the ones that you've been working with for an extended period of time where you say, I'll give them another week. Okay, I'll give them another 30 days, another 60 days. Oh, shoot, what happened? Wow, they're 90 days past due and now they're not taking my call and I have no idea where they are. I mean, that puts yourself in a very tough situation. So, while no one wants to be a collections company, while no one wants to play the bad guy or the bad gal, you really do need to keep a close watch on these customers because, as we talked earlier about some of the challenges we're faced with this year, these companies are going to continue having difficulties paying their vendors and suppliers. So really, it's always a good practice just to keep a close watch on that and don't let these accounts get significantly past due before they start taking action.
Yeah, you brought up a really good point that, like you said, a majority of the claims are coming from really established companies. It's not your new customers. It's actually the majority of claims are coming from established brands. We've also seen the same. I mean, I'm just saying for our audience out there that it's funny because sometimes you see these like merger news of like these two companies merging and oh, like they strategically decided to come together and all this. And it's like you'd be surprised to understand how many of those are as a result of one of those companies was on their knees and had liquidity issues. And the buy was so cheap for the other side that they said, this is the best deal of a lifetime. Let's go. And I mean, I literally, like, PR wise, there's so much out there that makes you think things are going well that again, I'm not going to name any names, but we've certainly worked with clients where it's like whoa, we've come across opportunities that these are premier brands of food and ag companies that have been around for 40, 50 years that you would have never guessed are struggling so badly, and they don't want to disrupt their legacy, right? Like, there's a lot of pride in the fact that they've been around for 40, 50 years. They have employees that they're worried about, and so they're trying to navigate without going to bankruptcy, trying to navigate, how in the world do I make all this work? And they're trying to pull every lever they can, but at the same point, they're not going to make it appear to the market that anything has changed, that they know that they still has to have that strong presence out there, that if they can get through this, they have to keep that going. And so, again, these long tenured brands could be the ones that potentially are the most at risk. And just because they have good PR doesn't necessarily mean that that's what's under the hood too. And so you bring a really good point there. Um, I think just a final point too is, clients making a lot of excuses. Sometimes too, when a client just stops talking, like when literally you've had a contact point that you've been able to email or somebody to call and they just stop taking the calls at some point in time, it's not just because they're easy. It's probably because they're avoiding you and they don't want to have the hard conversation. And so, for our audience, just those are some key signs. But Brett, you have delivered some great value. I love that we've been able to dive into just how do you manage, clients and relationships and AR, and how do you manage this whole function. So, just so appreciate having you on the show, bud.
Hey, it's been my pleasure, Mason. This was a great conversation. Hopefully, did leave some valuable nuggets here. But yeah, thanks for having me. Best of luck with this series. I'm sure it's gonna produce a lot of success. This was fantastic.
No, no, absolutely. So glad we could get this out for people of, yeah, what's the real take on AR management and risk management related to it, right? So really appreciate you. Looking forward to being able to get this out to our audience, and thank you to everybody that's listening in. Again, inaugural episode. So thank you, Brett, for kind of being our guinea pig too as well. So thank you for that.
You got it. Thanks for having me.
Cool. That was good. Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it.